Hi and welcome to Equities Bank. My name is Jonas, and I will go through fairly quickly our house view. And this week I will actually try to do it. I think I say that every week, but I never manage to do it. But anyways, in terms of our asset allocation, in terms of our forecast, we haven't changed anything. And what you should note here is that we are still maximum overweight in our equity allocation, and that's what I'm going to try to motivate. Given all the banking turmoil we've seen, how come that we haven't shifted down our risk allocation? And I think there are numerous reasons for this. First of all, we do not leave our overall picture, i.e. we still believe that we're in a low growth environment, but we move from high inflation to normal inflation. That by itself gives a huge positive delta in possible equity outcomes, a delta of 25%. That's the sort of the macro backdrop that we still think is relevant. Then we also calculate the 60-40 versus a 40-60 portfolio, and for us in our asset management, given the time horizon and the volatility that we're targeting, we're seeing a little move on the downside, but then we're back to we should still statistically be overweight 60 to 40%, i.e. we're not breaking below the green barrier. The beige line here is sort of an indicator for this, and yes, it moved down but then rebounded, so we haven't really seen that much of a scare for us to underweight the equities, and I think that's important given the rebound that we've also seen in Nasdaq, for example. In terms of growth outlook, I know there are discussions now on what does the banking freeze mean in terms of growth. There will be implications, I'm sure of it, but until we can quantify and see them, and we update this daily, we think is the risk of acting too early, and especially too negatively, will cost you in terms of your performance versus indices or your absolute return focus, whatever you have. In terms of growth outlook in the US, we still see a 20% recession chance, and that's been sort of almost fixed by that for almost 12 months now. It's a really stubborn signal here, which is quite interesting. Obviously lifted by retail, pushed down by retail, i.e. lower recession risk, and pushed up by the manufacturing side. And when we target the manufacturing side, because that's where we're going to see the weakness, which is obviously going to be helped now by the dollar as well. But anyway, we can still see the soft landing and then the rebound, and yes, heightened recession risk. But this is something that we've lived with for the last 6 months. We always knew this is going to happen. We always knew that the Fed will meet this by rate cuts. So the growth outlook hasn't really changed yet, at least, and I think it's too early to sort of make decisions based on guessing, and I will try to derive the implications of the banking freeze and what it means to us. But again, global growth, strong, OECD production, rebounding, nothing new here. US GDP models, daily and weekly updated. You can't really see a downside yet, at least, not even in the daily. This is the weekly one. Sweden, yes, still actually in a rebound phase. So it could be, if it does not turn out to be a recession due to the banking freeze, you could severely lose out on performance, I think, because this is one of those, do you trust the data or do you trust the storytelling? We trust data, and to be perfectly honest, you obviously can do a lot of money on trading stories, but we like to see it before we believe it in that sense. Credit expansion, yes, positive. So before we go into the banking freeze, if the growth outlook so far is unchanged, and how about inflation? Inflation is still working its way lower. And you can see here that we're actually pinpointing almost a full percentage drop in headline CPI for the next monthly reading for the US. That's a massive move on the downside. 70% of the last month-on-month number was shelter-oriented. Arithmetically, we know that inflation will come lower just by doing year-on-year math. But what about this shelter data? 70% of the month-on-month there was shelter. What if we get rid of that? Then all of a sudden inflation will plummet on the downside. We know from the housing pricing that yes, shelter will plummet. We always knew that it's a reason. But the blue line, which is shelter, or owner's equivalent rent, is just keep on climbing. But when we do indicators, we can see the sharp downside. There is a good budgetary/political reason for the lag between what's happening in the real housing market and what happens to the shelter data, given the way subsidies has to work also with the budget process, so it sort of makes sense. But that means that what we see in the real economy takes about 6 to 12 months before it eats its way through to the shelter. And if shelter was 70% of the move, that means all of a sudden people start to discount and start to argue more for falling CPI. And I think that's really sort of the backdrop of the whole story in terms of growth, inflation, and then we have to deal with it with the banking freeze. And obviously, supply bottlenecks, yes, they are already deflationary. Nothing new here. Yes, wage growth has plummeted, it's sticky, everything's rolling over. It's not sticky, we never argued it was sticky, and we argue against those people that argue that inflation could remain sticky or whatever. So far, it just follows historical patterns, i.e. all subsectors moves where the headline is moving, and the headline is moving sharply lower. Don't forget, China is exporting deflation. Also in terms of individual wage data, which are broken up here, you can actually see they're rolling over quite neatly and quite clearly, i.e. there is no sticky wage data in the US, and there's no sticky CPI data whatsoever. And if you ask the average person on the street, where is inflation going to be in 1 year's time, the answer will be below 1%. Now that's very aggressive. And that's way beyond what I think. But that said, the pressure is what it is, and it's moving rapidly lower. Now, on top of all this, in terms of growth and inflation, that's a great equity story. I mean, good growth, or at least solid growth. Now we're in a re-acceleration of growth on top of falling inflation. Then on top of that, we need to throw this the context of the banking freeze and the Fed. Now, obviously, if you look into the May meeting, this dark blue line is moved up to 83.2%. i.e. they won't hike in May anymore. There was a 50-50 call mid last week. Now it's 80% chance of more moves. So i.e. you have to sort of start doing the math in terms of the banking freeze. What does that mean in terms of rate hikes, or how much does the banking freeze correspond to a rate hike that we can take out from the rate curve, because the market is doing the work for them. And the curve then falls, obviously, all the way out to longer durations, re-steepens, etc., etc. Actually, we have both re-steepening and we also long U.S. Treasuries on board. So I think that's, right now we have a good time in those books. But it's certainly interesting in terms of what this means. This is where the U.S. Fed Fund future curve was 4 weeks ago, 2 weeks ago, and this is just from last week. And you can clearly see the shift downwards, which sort of makes sense. The market's doing the work for the Fed. They don't have to hike. And if they hike, they could probably squeeze it too much. That also means that the Fed curve is on a very steeper trajectory than the ECB. And that also means this will become a currency play, which is something that we are trying to front run by taking down the dollar exposure quite hefty. This also means that as we price larger cuts in the US, there are specific sectors that can make more money on this. And I think artificial intelligence is one of those. We also added to NASDAQ more broadly last week as well. We're actually doing another leg today, so I can't comment more than we're buying sort of NASDAQ-ish equities. But the idea that the priced rate cuts will actually lift this equity sector sort of makes sense, as long as the banking freeze doesn't sort of make the whole economy to implode. And then you can put the AI strategy versus month-on-month CPI is inverted, or the consumer expectation is also inverted. But this whole idea that this banking freeze could actually be a trigger for reallocation, not underweighting equities, is something that we think is quite interesting. Now, on top of this, rates would obviously move lower. We were long US Treasuries from 4.2% on the 10-year in the US. It was a great trade, a boring trade, great trade, a boring trade. Now it's a great trade again. That also means that we have enough security in the portfolios to sort of enable us to be that forward leaning in terms of adding more tech. And this is really where then it comes to the next layer. So if we're positive on growth, we see a soft landing in growth globally. It looks great. But also we have a rapidly falling inflation. What about this banking freeze? And I'm going to try to illustrate the way we're thinking and then come back to the equity model a bit later on. But first of all, there are a number of programs that the US is rolling out. We won't go through all of them, but I'll try to just illustrate what they look like in the graph. And here you can see the overweight stimulus that came out, and here you have the pandemic. 2019, a very specific date, and I will come back to why they pushed up this much liquidity in the system, but there was a very good reason for that. And this is what we're seeing now due to the banking freeze. So it's quite a hefty program. It's just looking at, we're high up on the axis, but this is billions and this is millions dollars. So quite large response. And I think what's really interesting, that if you compare to the financial conditions move sharply tighter during the pandemic, and then we hike rates and it moves quite for a prolonged time, and that's probably what matters more here than the absolute level. And this is the banking freeze. So yes, a move up, and we're taking back some 25-30% of the move. It almost looks a bit, is that all? Is that all we're concerned about? But you also have to put this into the context of the program. I'll come back to that. This is the move in dollar US government bonds liquidity index, and here you have the 08 experience, and then you have the pandemic, and here are the rate hikes, and this is the banking freeze. So that means if you look at this and combine them, and I had the fortune of working in New York in 07, 08, and it was clear then that you had a huge amount of stress in the market without anything really happening from the policymakers. Now, people are using the discount window because that's something banks can do on their own. It's how they change the conditionality of the discount window that actually is more important than the other programs. But when I highlight this is that the market in terms of financial stress front ran the programs that came from the governments, and this is just one. And obviously there were more and more important ones, and then finally things started happening in between the late 08 into 09. That means that the market had been concerned since 07, 08, and then 09 they saw something happening. In 2019 in the pandemic, you saw this freeze popping up in the market, and the Fed, the US government combined efforts were there to quite quick respond. They only took about 3 weeks. And this time around, you'll see a small move in the liquidity, and then you have actions between the banking freeze that happened on a Friday in terms of Silicon Valley Bank, and everything was ready and set Sunday evening, and the cash was out Monday morning. That means this is one of the quickest responses and also a very hefty response. And that is probably a key variable for us to look at to understand that, given everything we talk about this, given the story making behind this, the move is it is there. We don't deny it, but it's very well maintained. So this could actually be a great success story of policy responses for the US. Now I'm leaving out more theoretical points of view in terms of bailing, bailouts, political ramifications, etc., etc. But it's quite interesting to see how fast the government acted. And that also means that the impact in terms of markets could be very, very limited. Now remember the program in 2019 that sort of doesn't make sense in terms of the pandemic. Why did they push out this amount of money? Well, that was because if you look at the plumbing of US banking, you can extract overnight financing rates that certain banks have if you make a bell curve of them. And what happened in late 2019 was that some banks had to finance themselves at 9%. Obviously, that is undoable. The market will collapse. The Fed saw this and pushed out liquidity. That was a massive program. Should probably be talked about a bit more of the experiences and what we learned in the end of 2019. But the Fed has certainly done a lesson on this, and they've talked a lot about it, they've written a lot about it. And the basic summary of this is that that's why they acted so aggressively this time around. So if they can contain this by having, that kind of move in financial stress, that's a great success. And if anything, you should be opportunistic in this environment as long as it holds, if you believe it's holds. And then you can be a pessimistic person and say it's not going to hold, it's going to collapse. Well, as I usually say, it's very hard to ever make money being a pessimist. Yeah, and then you can point out, the black swans, etc., etc. But I'm not so sure the black swans. I don't know if you're colorblind, all swans are black or gray, whatever. But leaving that aside, obviously there are great funds out there making a great reward. We all know who they are, and that's hats off to them. But in terms of creating a more allocation strategy working in terms of risk, etc., for us it makes sense to add those hedges when we see the time for them. We have not done that this time around. What we have done is we sold off banks and bought more tech. Stress in Europe, yes, accelerating a bit, but do remember the difference between Swiss law in terms of AT1s or COCOs and European law. Obviously, we see the stress in Deutsche Bank. Obviously, we look at it. Obviously, we don't think it's that stressful that the market wants to make out. So we're monitoring that, but we hold on to our positions. Now, this is the calendar for the next 2 weeks. So there's a bunch of data coming out. You have non-farm, ISM, PCE, JOLTS, ADP, you have Tankan, you have IFO, and Swedish GDP indicator. I've tried to, in 2 pages, make sort of a roadmap of where we think things are going. Unemployment rate to move up, non-farm payrolls move lower, US PCE rolling over, wages obviously continue to roll over, ISM to pick up, for example, and the Japanese Tankan continue to grow. You have the Chinese PMI, just look at that rebound, great. We try to still make money on that. And you have European core CPI, which we think is going to start to peak. And quite encouragingly, also keep an eye on German retail sales that could actually start to trough. That would be great, given where the leading capability between German economy and the Swedish economy. Obviously front run already by sentiment indicators, but that's a quite interesting couple of weeks ahead of us. In terms of Sweden, yes, we have a low retail sales, the worst ever. Yes, it was actually in recessionary camp before the first hikes, and yes, we are spending a record proportion of our disposable income just to service debt. So compared to the US. So this is a very rate hike sensitive Swedish consumer, but this is all news. We already knew that. What we are targeting now is trying to find the trough in Swedish real estate and keep on with the Swedish companies and in equity allocation that are exposed to the global economy a lot more. Now, in terms of these kind of started to be a little bit of a fish hooks on Swedish real estate, which we think is great. Given the price development that we've seen for the last period in Sweden, very, very depressing, it actually made us to fall in a type of heat map. So in terms of price to income ratio, house price to rent ratio, nominal price index, real price index, Sweden is actually a fairly low valued real estate market, which is quite good. Private sector credit growth sticks out a bit red, but we all knew that we have to have that in order to just roll our debts. That said, a trough in this will be quite interesting to try to make money on. For us, we're sticking to Swedish equity, given the macro indicator that we see there. And then in Swedish krona, for those who are interested, we think we have been a quite interesting moves in 2023, quite well front run by the rate market. And right now we see that we're going to hover around 1040, 1050 for the next month. So a bit less exciting than the 2022 experience there. The dollar stock imploded and then, exploded and then it imploded. But that's certainly something that we take into account in our global equity selection as well. In terms of equities, I already mentioned that Chinese, given the push in liquidity and the high frequency data, we're sticking to our guns on a small proportion that we still have in Chinese equities. In terms of the US, or more broadly global speaking, we think it's encouraging when we look at our data range indicator that institutions are still buying equities rather than selling. So we still see an upside, and that's despite the banking freeze. And margin debt momentum, so actually it has troughed, and who knows, when we break zero, then the equity market will look completely different. So we want to front run that as well. In terms of equity sentiment, and this is actually an equity sentiment which is designed to be able to trade upon, actually has to mean something, not just a sentiment indicator. It actually moved up here when I updated this morning. And it's very interesting now to compare what we saw in April, May last year, as September into early October of last year. And given the banking freeze, you can actually see an unchanged and even positive, more positive sentiment today than it was before the banking freeze, which sort of is a bit weird. But it sort of makes sense that I think people are looking at similar stuff that we're looking at in terms of estimating that so far, so good. And we all know one thing, if you jump off the equity market and the equity market is still buying, still more eager to buy, you're going to miss out on those great days. And it's eager to buy if you look at a daily range indicator, and I will come back to Hubel liquidity ratio as well. In terms of media in the US, they're quite balanced. Compare that to European media when we try to describe what's going on in the USA equity market and bank market. Needless to say, we are taking a bit more negative view here in Europe, which I think is a bit unsubstantiated actually, so far. In terms of risk, yes, we saw risk coming down and then it rebounded, which is really good fun for us. Completely different from what we saw in 2022. So right now, in terms of CDSs, broad CDSs, rate spreads, FX vol, fixed income vol, you should actually hold on to your equities. The liquidity in bonds still improving and showing you should hold on to equities. Fear and greed, yes, you're taking it a bit on the chin here, but look at that move. I mean, it's fairly small compared to what we've seen in the past. You can actually see the same move right there. The small gray move areas. I mean, nothing compared to what we saw in 2022 or 2019 or 15, 16. So far, I think we should be very careful of being too negative on this. And especially if you look at this is the core model for our asset allocation actually right now. When things are stressed, we need to be sure that we try to get every day right. In order to protect the portfolios and work with them. So we look here are the key matrices that everybody's looking at in terms of counterparty risk in the US, dollar liquidity, and vol curves. And pretty much we were fortunate enough to roll out of banking stocks in mid-February, and then we took off the rest of it in March. And we can really see the squeeze lower in terms of counterparty risk, dollar liquidity, compared to September. Sharply moved lower. September, October, everything had to wait for the CPI number that improved the pivot from the Fed fund pricing, and then everything could turn around. This time around, everything turned overnight, basically in one weekend, and then it's been a volatile trip. But the core message here that in terms of counterparty risk, dollar liquidity, and vol curves, we're going back to what I saw before in terms of financial conditions. It seems that for the time being, everything is working. That said, obviously there will be regional banks that are going to have problems in the US, but to be massively going underweight equities or going short equities, we don't think that's the time now. So we are trying to utilize this in order to reallocate. So far, we're actually making good money on this, and we're probably going to change this when things are developing to the south, if it develops to the south. Otherwise, we hopefully should just stick to it. Because obviously, tech is thriving this idea that if the economy doesn't break and rates are moving lower, great. Don't forget, flows are coming back from cash positions. Options are not showing any stress. They're still showing an upside on the equity market. In terms of factor productivity, yes, you still have an upside. And this is actually very well correlated to growth in equity markets. So the idea that corporates are still profitable is actually quite important. And also a cyclically adjusted P number, and then we put it on a momentum basis in order to be able to trade upon it. We can actually still see that we should be in a buying mood on the equity market. And this is very important liquidity ratio that I find that if the market was more stressed to protect and sell off in order to limit the downside, or when it turns around, before the actual spot market turns around, people are more and more stressed and inclined to be on the buy side. That's hugely important for us. Right now we are up here, so basically despite or during the banking freeze, people were more inclined to buy the upside than they were to sell off and protect the downside. And I think that's hugely important for our whole interpretation of this, to try to see that if we're right or wrong in trying to stick to our guns in the overweight on the equity side. And as long as the data doesn't change, we won't change either. Don't forget, this all happens with earnings revisions and price target revisions in a sharply improving and rebounding environment. And that obviously comes on the back on the rebound in global economy. So if we were to go through this in an event with the banking freeze, this is the picture we still have to trade, and that's what we traded in back in January. So you really need to crack the system in order to be bearish on this. And as I just pointed out, so far you can see a crack, but it seems to be mended. But we're going to follow that every single day, of course. Obviously, then also economic surprises moving earnings revisions. So that's nothing new there, really. So with that brief run through, we start off looking at, don't forget, growth is still supportive of equities, earnings revisions, price target revisions, liquidity ratios, buying trends are still supportive of equities, inflation is still rolling over. We can see the cracks, we can see the challenge, but so far the speed and magnitude of what's been pushed up in the financial system seems to be mending the financial stress. If that conclusion stands, then yes, we should reallocate to more take-edgy strategies, trying to ride the rate curve basically. And if it changed to the worse, then yes, then we will sell off equities and hedge. But we have to see that change for the worst, because what we can see right now is a very limited and quite acutely and really actually quite great response from the policymakers of limiting the negative factors. Then obviously there will be individual names that we will take out of. Yes, we have sold off European banks, so we're taking consequences on this, and also some national indices that has a huge overweight to equities, banking equities, like the Polish position we took off. And we shift that into tick, basically. But with those words, I will leave it at that, and we'll be back in a couple of weeks' time. Thank you so much.